Opendoor Technologies is currently trading at exactly $7.78, showing a daily gain of roughly 0.52% as we speak. While the after-hours market has seen a slight dip to 772, the primary narrative right now is the sheer magnitude of the recovery we are witnessing on the chart. To understand why this price point is significant, you have to look at where we were just a few months ago. We are not just looking at a stock that is up a few percentage points. We are looking at a company that was effectively left for dead in the summer of 2025, trading as low as 51 cents, now sitting nearly 1,500% higher. This is not normal market behavior. This is a violent repricing of reality. The expectation from the broader market for the last 2 years was that Opendoor was a zero. The consensus was that the iBuying model, where a company uses debt to buy homes, flip them, and pocket the spread, was fundamentally broken in a high interest rate environment. Investors expected bankruptcy or a take-under at pennies on the dollar. That was the expectation. The reality, however, has smashed that thesis into pieces. The reality is that Opendoor is no longer just an iBuyer. Under the new leadership of Kaz Nejatian, the former Shopify executive, the company is pivoting aggressively into an asset-light, software-enabled business platform. The market is no longer pricing in a housing flipper, it is pricing in a high-margin tech platform that just happens to sell houses. This disconnect between the bankruptcy narrative and the tech pivot reality is what has fueled this massive run to $7.78. Let's dig into the immediate price action, because $7.78 is a critical battlefield. Technically, we are sitting right at a resistance level that dates back to the consolidation zones of late 2023. If the bulls can hold this level and push through $8, we enter a gap in the volume profile where there is very little selling pressure until the double digits. However, the movement today suggests a pause for breath. You can see the exhaustion in the intraday candles. The volume is thinning out a bit as traders decide whether to take profits after a 1,300% run or to double down for the next leg. This hesitation is where retail investors often get hurt. They see the green and they chase, ignoring the fact that the stock is technically overextended on the daily RSI. But here is the contrarian take. Normally, an overbought stock crashes. In this case, the short interest is providing a floor. We have over 21% of the float currently sold short. That is a massive amount of fuel sitting on the sidelines. Every time the stock dips, short sellers who are trapped from the $3 and $4 levels are rushing to cover, creating a natural buoyancy. We need to talk about the short squeeze mechanics because this is what is driving the volatility. When a stock rises from 50 cents to nearly $8 in 5 months, short sellers are not just underwater, they are being liquidated. The cost to borrow shares has been fluctuating, and days to cover is hovering around 1.4. That sounds low, but with the volume exploding, it means the exit door is very narrow. If we get one more piece of positive news, perhaps a partnership announcement or a favorable CPI print, those shorts will be forced to buy back stock at any price, potentially sending this parabolic. However, you must be careful. Short squeezes work both ways. If the momentum breaks, the rush for the exits will be just as violent to the downside. Now, let's look at the fundamental catalyst changing the company's DNA. The arrival of Kaz Nejatian as CEO was the turning point. He brought the Shopify mafia mentality to a real estate company. The old Opendoor was heavy on assets and heavy on risk. They owned the homes. If the housing market crashed, Opendoor crashed. The new Opendoor, or Opendoor 2.0 as they are calling it in the Q3 earnings calls, is focused on exclusives. This is their marketplace where they connect buyers and sellers directly using their algorithms to price the home without Opendoor actually taking the home onto its own balance sheet. This shifts the revenue quality from low-margin transaction fees to potentially high-margin software service fees. This is why the stock is re-rating. The market loves software margins, it hates real estate margins. If Opendoor can prove that a significant chunk of its future revenue will come from this asset-light model, then a $7 share price is actually cheap compared to the multiples of companies like Zillow. But we have to look at the macro environment that is allowing this to happen. We are in late 2025. The Federal Reserve has finally started to ease off the brake pedal, and while mortgage rates haven't plummeted to 3%, they have stabilized. Stability is all Opendoor needs. The iBuying model does not need booming prices, it needs predictable prices. When volatility in home values decreases, Opendoor's algorithms can price risk more accurately, leading to better unit economics per home. In the recent earnings report, we saw that while revenue was down year over year due to their deliberate shrinking of inventory, the contribution margins, the profit they make on each home after interest and holding costs, are inching back up. They beat revenue estimates with $915 million in Q3, which shows that even as they pivot, the core engine is still running. However, do not ignore the risks. The company posted a net loss of $90 million last quarter. They are still burning cash. The tech pivot is exciting, but right now it is largely a story. The revenue from the software side is still a small part of the pie. You are paying $7.78 for a promise, not for current profits. If the housing market takes another leg down, or if the exclusives platform fails to gain traction with agents and sellers, the stock will re-rate back to its book value, which is significantly lower than where we are today. Furthermore, there is the issue of dilution. The company recently announced a distribution of tradable warrants to shareholders. While this sounds like a bonus, warrants effectively increase the supply of shares in the future. It is a complex financial engineering move that reminds us that this company is still very much in a survival and restructure mode. I want you to pause and look at your portfolio right now. Comment below with your average cost basis on Opendoor. Did you hold through the pain of the sub-$1 days, or are you entering fresh here at $7? And here is a question for the bulls. Do you genuinely believe the AI pivot is a fundamental change in the business model, or do you think management is just using the right buzzwords to pump the stock? I want to see your take in the comments, because the sentiment on this is incredibly divided. Let's expand on the institutional activity we are seeing. Usually, in a move of this magnitude, you see smart money selling into the strength. But if you look at the filings, there has been a surprising amount of accumulation. It seems that some hedge funds are betting on the shopification of real estate. They are betting that Opendoor's data advantage, the millions of home inspections, offers, and closings they have processed, gives them a proprietary edge in training AI models to value real estate better than anyone else. If Zillow is the Google of real estate search, Opendoor wants to be the Amazon of the transaction. The data they have is the moat. If they can monetize that data through software products sold to banks, insurers, or other real estate investors, the total addressable market expands massively. However, we must address the short report angle. There are still vocal critics who argue that Opendoor is essentially insolvent, and that this rally is a dead cat bounce fueled by retail mania. They point to the high levels of stock-based compensation and the recent insider selling by executives. It is always a red flag when the stock jumps 1,300% and the people running the company are selling shares rather than buying. While some selling is for tax purposes, you want to see insider conviction at these levels. The lack of open market buying from the C-suite suggests they might think the price has run ahead of the fundamentals. You need to watch the fail-to-deliver data closely in the coming weeks. A spike in FTDs would indicate that naked shorting is happening or that liquidity is drying up, which often precedes a violent move in either direction. Another critical factor to watch is the spread between the exclusives volume and the traditional iBuying volume. In the last quarter, the company highlighted that they are actively trying to reduce the number of homes they hold. This is good for risk, but it means revenue will optically shrink. Investors who only look at the top-line revenue number might panic when they see sales drop, not realizing that the quality of the revenue is improving. You need to look at contribution profit and adjusted EBITDA. If Opendoor can hit EBITDA break-even in 2026, as they have forecasted, the short thesis effectively dies. A profitable Opendoor at $7 is a steal. A money-losing Opendoor at $7